This is the Alternative Investing Advantage podcast from Advanta IRA, where we show you how to explore investments beyond Wall Street and open your eyes to new options for your portfolio. It's time to take control and give yourself the freedom to choose where you invest your money.
Hi, and welcome to another edition of the Alternative Investing Advantage podcast. Today, we are very pleased to welcome on Jason DeLorenzo. He is the CEO and founder of Volland Options Positioning and an RIA with Advanta Funds. So we are really kind of going to be digging into something that is maybe something that you've heard about a lot about. You know, everyone's kind of heard about options, and it's maybe kind of a little bit more of an ethereal concept that a lot of investors think about. You know, it's easy enough to wrap your head around. You know, you buy something, you sell something, but when it comes to options and futures, you know, people maybe think they understand, but they're not necessarily sure how or where to start. The big problem with the market is just that there is so much data out there, and it is something that you need to be incredibly astute to really kind of discern and create value. But how do you kind of get started with that? Where do you kind of get the data, and how do you kind of process it and take it in to make those informed decisions? Well, that's exactly why we have Jason on here today to talk about what he's developing and how people can better understand this to be a more informed investor in the space. So Jason, again, really appreciate you being on with us today. If you wouldn't mind, kind of give us a little bit of background about yourself, you know, how you kind of came to be in the position you're in, you know, how you founded your company, and also, you know, what you're aiming to do in the market and help individuals, you know, again, you know, navigate and make informed decisions.
Yeah, Alex, thank you for having me on. It's a pleasure to talk to you. I mean, a little bit of background about me. My name is Jason DeLorenzo. I mean, from an education standpoint, I have my master's in economics. And as an economist, what we tend to do is try to find inefficiencies in the markets, even, you know, whether it's financial markets or, you know, government markets, you know, any kind of place. We try to find inefficiencies or try to measure something to try to understand what the results would be of any action. And one time I had an option trade that I thought was going to be a big winner, and it turned out to be a little loser. And you know, keep a long story short, but you know, when most people would be discouraged by that, and I'm sure many of your viewers, if they ever tried to trade options, found themselves getting frustrated and then said, options are terrible things and I will never deal with them. I saw an opportunity. I said, you know, if this went against me, I lose all my money. And this went for me and I only lost a little bit of money. So, so it was an aha moment. Like, there's some kind of edge here. And that was back in about 2008 timeframe, 2007, 2008. And I dove in, you know, kind of my personality. I dove in. I did a lot of academic research, a lot of interviews. I got mentored by a former market maker, which we'll talk about, I guess, a little bit later, and developed, you know, and as an economist too, we're data scientists, developed some data in order to exploit or at least identify where the edge is in these option markets.
Great. Yeah. Now, it's well and good to kind of understand that, you know, you have the initial, you know, onset of identifying, you know, say, hey, look, like this worked, but it didn't work as well as it could have, you know, and the nice thing, at least with data, so you can kind of go back and scrape through it to say, okay, well, what happened? You know, it's easy to say, hey, I didn't make as much money as I wanted to. But at least with financial markets and especially options, there's so much data that if you can digest it and take it in, you know, you can, again, make more informed decisions in the future and try to identify those trends to, again, make more money ideally, but, you know, be more informed with, you know, what is driving the decisions you're making. So what are some of the inefficiencies, at least currently, that we're seeing? You know, it's well and good to talk about, you know, what happened in 2008, and I'm sure some of those are still pervasive in the market today. But, you know, when it comes to, you know, getting started in options, you know, what are, again, some of the big inefficiencies or things that, you know, you've identified that you're trying to fix with your approach to it?
So first, I mean, before I get into that, let me talk about a little bit about what an option is, right?
Sure.
Options are derivative contracts, and they are the right, but not obligation, to buy or sell underlying stock at a certain price by a certain time. Okay, so there's a bunch of little variables in there. The underlying price, by a certain time. So there's a time component. Because there's a time component, there's an interest rate component. And then that option costs money itself. So there's a premium component too. So there's a lot of variables in options. But ultimately, when CBOE introduced them into the markets, I believe in 1972, they were introduced as an insurance product, okay? An insurance on your portfolio. So if you are long, a bunch of stocks or, you can buy options in that stock. And if the market comes down, then you would not lose as much money. You would be hedging. And so that essentially is where options come from. And they are still an insurance product in its very core, right? And so that's, it's funny that options are seen today as a very risky thing when the whole core of what they are is to mitigate risk, right? And so that, back in 2008, though, that price of what that option was, it was a biotech stock that I thought I had friends that told me this biotech stock is going to fail. It's binary, it's binary catalyst. And so I couldn't short anything. So I bought my first put, and, the price of that premium, the price of that put, was too large for the move that the underlying made. So I ended up only losing a little bit of money, which is not really an edge in options per se. It was just a principle of options, right? It was just one of the variables that I didn't even know I had to take into account. But that right now, though, the inefficiencies in options tend to be more about liquidity, because there are only a certain number of market makers that really can trade these things and provide liquidity to the markets. That's why we started Volland, is because we knew that these middlemen who had to facilitate option trades were, that was a central point of concentration for all option trades. So now if I focus on these middlemen, I can see what what institutions and customers are positioned at, and I could also see how they are positioned to determine how they are going to hedge. These middlemen, they try to make spreads on options. So, kind of like equities, there's a bid and an ask, and they try to make a spread between the bid and the ask when they buy and sell their options. So that was one of the inefficiencies that we saw. We could, this centralized place where we could see everybody's positioning. You don't really have that so much in equities. You don't know, there's top holders. You could get those, statistics on any, Yahoo Finance or something like that. But on options, that isn't really public. So although now it is, there's a feed that shows you every single option trade, and that's what Volland taps into in order to see what the positioning is. And using that, you can kind of see, well, institutions are hedged under this number, this price. So this is when institutions or, people are afraid, when the stock price goes down further than this. Or in the upside, this is when institutions think that this is the price that they should be selling their stocks at. So you can kind of look at that and say, oh, well, if this is the true institutional positioning, then I know, what I can expect from these option trades. So that's kind of the inefficiency. But the one thing coming onto this podcast that I wanted to express is options are only risky if you are risky with them. And they're ultimately an insurance product. And you could control your risk using options a lot better than you can even stop orders or, things like that. And so that's ultimately the point of coming on is, this is a long-term alternative investment that if you were smart on how to use your options, you can extract, you could be a little less fearful about how the market is going to act.
Yeah, and that's one thing, at least, that I kind of talk to my peers or anyone that asks me anecdotally about options. Again, I'm by no means an expert. My expertise in the alternative space lies not in this area. I definitely know a lot about the alternative structures tax code and other types of the area. But what I always normally tell people, I'm like, look, first and foremost, I'm not the expert. Talk to someone like Jason. But it's that again, to that point of risk, are they inherently very risky? They can be, just like anything can be. But especially with options, it's the kind of the greed component that I tell people to monitor. It's easy to kind of see the big sexy headlines of like, hey, options traders with X amount of input created, Y of output of returns on. It's like, oh, that's really awesome. But that can be great. But the nice thing about options, to your point, is that you can buy and sell them against underlying securities that will mitigate that risk. You can kind of set, hey, here's my target return I'm looking for, but hey, on the bottom end, do I want to just be able to scrape a net even position, or do I want to say, hey, look, I'd like a little bit more of a flux to be able to kind of let the market do what it needs to do, but if it's really going down, I can clip my losses with certain trades to that effect, which people often kind of don't look at that. And it's like, hey, you can cover these things. If you're doing things naked or uncovered, yeah, there's a ton of risk. There could be a lot of reward, but do you want to invest in something that has unlimited downside potential? Most people would say no. And should anyone be doing that? Very few people, and you really need to maybe be a full-time professional options trader to even consider doing something that would be naked in nature. So that's kind of the high level of what I tell people. And most people think, oh, well, I didn't really think of it like that. I'm like, exactly. We get too kind of caught up and can't see the trees through the forest, if you will. So, from that.
Times I've turned on YouTube and gotten an ad of somebody saying, I turned $500 into this yacht. You're like, well, first of all, why are you buying a yacht? But second of all, you just, it's possible to do that. It is not probable. It doesn't sell many subscriptions if you go, I turned $500 into 100 in a flash, and it's not, and that's, people get into options because they see these Lamborghinis being driven around and, hey, I have 3 girls on each arm and, because I did this with options. And that's not really how it works. And, investing, as too, is a business. We're here to make consistent returns, and we're trying to exploit an edge to keep the lights on, right? So that's more how people should think of options, and try to stay away from the get rich quick of these Lamborghini drivers.
Yeah, it's a lot easier to sell a Lamborghini and a 500x return than it is to say, hey, over the past 5 years we have seen a risk adjusted return for our clients of 12 to 15%. I would jump on board with that in a heartbeat, because again, that's manageable. That's
Right.
that's good. Is it unrealistic? No. Is it better than average? To a point. I mean, people don't often take into account the true cost of inflation. So is that 15% return really 15? No, it's probably closer to a targeted like 6 to 7. But again, that's good. That'll keep the lights on. That will get you to where you want to go.
Right.
Slow and steady wins the race. So again, we can kind of opine on our opinion about the outward viewpoint that people put out there, especially in the information and social media age. But kind of coming back to the core of what I want to focus on is looking at it from the investor standpoint. Again, people understand, and especially from our world, options being a right, not an obligation to buy something for a certain price. You can extrapolate that any real estate contract you've ever signed is an option at its core. You've agreed to buy something, they've agreed to sell it, you have X amount of days to close, you paid a premium as far as an escrow on that, and if you don't exercise it, you would be out your deposit, right? Again, the core focus, again, is very well understood by people. You just don't kind of think about it in that context when it comes to stocks, right? But everyone understands the contract. You're not obligated to buy this thing, but you can, and they're obligated to sell it. So from a high level, when it comes to, again, those market inefficiencies, how does that really affect the investor when it comes to buying options? And what kind of options are most often affected by the inefficiencies that you are looking to fix with your products?
So with Volland, which is, an option dashboard, which unless you are kind of an active trader, and my understanding is this podcast doesn't exactly have like active traders who are kind of getting in and out, in like 2 weeks, 3 weeks, stuff like that. It's trying to identify where the options positioning is. So, and we have about 250 stocks and ETFs, et cetera, in there. So, I mean, if you, let's say you're very bullish on financials, you can log into our dashboard and say, XLF, the ETF for financial stocks, XLF has a strong, call area right here, imbalance, and then a strong put imbalance right over here. And you could see, all right, well, that could be my stop and my, target price when I'm doing my investment strategies, right? So that ultimately is what I think you can use Volland for if you're a long-term investor. And you can just get the update once per day. We have several subscriptions, updates once a day, 3 times a day, every 30 minutes and every 5 minutes. And obviously the every 5 minute kind of is for like the day trader. They're going in and out. They're kind of seeing the 0 DTE options, which are options that expire in the same day that you buy them. Those are that's kind of a different category of investor. But when you're doing this kind of stuff, you can make some solid trade plans based on your understanding of the underlying with Volland, because then you could see kind of how institutions are positioned.
Gotcha. Now, when it comes to the institutional side of things, that's one thing that I always find fascinating and kind of an underutilized viewpoint of what people really digest. With the information age, is things that people don't realize can be incredibly beneficial.
Oh, yeah.
They like to look at what they view of people. There's so much information coming from kind of individual sources, but when you kind of go to just the raw data of look at what the big people are doing, it paints a much better picture, in my opinion, than what any talking head's gonna say. Unless the talking head is someone that's literally saying, "Hey, look at this data X, Y, and Z, and we can make an informed decision against it." But no one does that. Again, they
Right.
want to get on there and promote something. Not for me to pass judgment, but when it comes to how much institutions really are invested in options, how has that kind of changed? Because at least from my perspective, it has kind of been an exponential growth curve of just how many large institutions are kind of playing the option game than they were maybe of a straight equities play maybe 10 years ago. And maybe I'm wrong on that. Again, I don't know. You're kind of the expert to that effect, but
Yeah.
how much more have they started relying and investing in options, and how has that kind of, again, because you have, I can't, is it, I can't remember the technical term for it, but it's like observation bias, where just the act of observing something can inherently change the outcome of the view of what you're doing.
Mhm.
So how has that kind of changed versus one, like how has the kind of institutional market changed with regard to its adoption of option utilization?
Well, first of all, option volumes have increased exponentially, especially since 2020. I guess enough people read that tail hedging, funds made all this money in 2020. But right now, we see on average, about 55 million contracts traded daily across all underlyings, etc. And that's data from OCC, the Options Clearing Corporation. So 55 million is a lot. Back, not to draw the curve too far back, but in 1972, that first day with options, 911 options were traded. But before 2020, it was more like 15, 20 million per day. And now it's 55. And, really it's computers have helped that out quite a bit. Also, the other thing that helped big time as far as institutional uh, uh, investing in options is the math has gotten better. And ever since in 1987, that was a derivative crash in October 19th. So that crash was because the math around option or derivatives really were not good enough. They didn't account for skew and certain things. But now the math has gotten so good that these bid ask spreads have narrowed and narrowed. And now if you try to buy an SPY option, you can have a bid ask spread of a penny at times. So the liquidity of options has definitely increased the institutional capability of using them. Also, the other thing too about institutions is, or even options in particular, I kind of see equities as like the hammer of the financial markets, because you could either buy it or you could sell it. There's a price there, yeah, you can do some stuff with, I want to buy it at this price, I want to sell it at this price, but ultimately you're just buying or selling the stock, right? The underlying, and you're just managing a position around that. Because options are have the underlying component, but also that premium component. It's for us, it's called implied volatility. You can look at that premium and say, are people expecting big moves or little moves, right? That time component and all these kind of like little components, you can structure your option trade to do different things at different strikes. I always kind of see it as the Swiss Army knife of financial instruments, and because you can structure, so you can have a thesis on so many different things other than just the price of the stock. So because institutions understand that, they take advantage of that quite a bit. And now you see, buys and sells of options all over the place on every underlying. Whereas about 15 years ago, you would have only seen, buying the puts and selling the calls, and that's just not true anymore. But I mean, there's still big funds that do that, but for the most part now, you have to pay attention to all the traffic because it is so diverse now with so many different people acting that you need that data in order to take advantage of options properly.
Yeah, absolutely. And at least kind of from my experience with a few different avenues of it, the propensity for this stuff to be, manipulated to the point of investor detriment has increased with some of these other alternatives on how they actually write these contracts. Not to get too far into the weeds of some really kind of bad things that I've seen with it. Again, the propensity for greed and other things that are allowed to happen can certainly work to the detriment. So when it comes to trying to navigate to the best road forward on looking at this data, how do you kind of sift through the noise? How do you turn those filters on and really kind of look at what's going to effectually make the best decision, the best data to make the decisions on? Because you have, again, with all the propensity for people to do naked trading, it's if people are trading when they don't own the underlying assets, then there's a lot of risk that can be put in there, and traffic can be, when you look at the traffic, there's a lot of stuff in there that might, again, just have a huge outweighed risk profile. So is that kind of information readily available, or again, how do you kind of sift through the noise of what people are doing to figure out, hey, okay, here's really where the institutional belief is versus what is kind of very speculative?
So I think that institutions, I mean, we see it in the data. Institutions are the primary, like one-sided buyer of options. You see the imbalance stronger when institutions are. I mean, there's a very famous fund from JP Morgan that they offer it. I think it's called the Hedged Equity Fund or something like that, where they're buying a put spread. We didn't really get into that, to the nomenclature of options, puts being protection, and they finance it selling a call, so that a call is the right to buy a stock, whereas a put is the right to sell it. And they structure this so large that the imbalance is, the way the dealers hedge, the imbalance of that position creates certain market movements because a lot of the hedging is done in the underlying itself, right? So when you talk about what is noise versus what is not noise, or what is data, it's really it comes down to, is this real data? Is this data that's coming in from someplace, or am I just making very large, broad assumptions and doing using my calculator on certain option metrics? And that's kind of where you have to come in. Volland, we take great pride in the fact that we're data scientists. We have we have a lot of very smart people behind. One of our guys studied at MIT, and another one has his master's in math and physics. So we have a lot of very smart people. We ingest and store the whole options feed, all 55 million of those options that are traded every day. We store that, and we know how dealers hedge. We've done the research, and so we're able to display exactly what dealers are doing, what customers are doing, and that's the kind of way we cut through. There's a lot of services out there that'll talk about option positioning. And unfortunately, that is, a lot of them are making assumptions based on open interest, which is how many contracts are currently open, or, some Greek kind of things you'll hear about, which is hedging. They're basically dealer hedging metrics, right? And so there's like a lot of these things that that are competitors. I don't really call them competitors. They're just kind of cheap versions of what we actually do. A lot of that is not reliable data. It's just kind of, trying to mathematically do something in an easy way instead of doing it the hard way, and putting in the work. So that's kind of, so that's how our dashboard gives edge in the marketplace now.
For sure, yeah, and it's again we did kind of again. There's a lot of really bespoke terms for the options marketplace. It's the easy ones are saying things like a call or a put. Again, being the right to buy or sell. I think the two basic ones. Are you betting? Are you trying to bet on the increase in value, or are you trying to bet on the decrease in value? Is the middle ground of what options are. But you'll hear all sorts of weird terms. I mean, you'll hear something like a condor, like, well, is it a bird or is it a type of options trade, right? There's a lot of stuff to kind of educate yourself on, especially with the shorthanded nomenclature in the market. And that could be a whole podcast on its own of just like saying, hey, here's all the terms you need to kind of know to be informed. But that's not kind of really the aim of this podcast. I want people to understand that there is a data-driven approach and what kind of is going on and where to kind of look for this information, because there's so much more than just kind of, again, like a talking point or a Bloomberg article to it. There's real stuff you can get into, and then, analyzing it is what's going to make you effective in this market. But again, keeping in mind that this is a significantly more complex investment strategy to a point. You can distill it down to digestible platforms, if you will, but there is homework that needs to be done, right? You can't just kind of come into this super green and say, hey, I'm going to make money and be an effective investor. Do your homework, start small, start safe, then titrate up your risk to where you find appropriate, and then, go forward. Now, from the perspective of regulatory viewpoints on this, that's what drives any financial market. We just have as of last Monday, have a regime change on, basically every governmental agency, right? People are coming in, things are changing. And with that, again, not for me to pass judgment one way or another on our government. Again, the beauty of it is that every 2 to 4 years we get a new changing of the guard, and things will happen. Whether it's good or bad, it is inherently something that is always in flux, and you have to navigate that as well. So when it comes to our incoming SEC chair or SEC chief, what kind of trends are we seeing as far as what's going to be, some things that you feel might be changing in the market? Are we going to see an increase in the availability of this? Is it going to be something where it kind of makes the markets a little bit more timid, or is the volume going to continue and kind of ramp up? Again, what are your kind of viewpoints on what's going to be changing on the regulatory front with this?
Yeah, so I mean, I think as far as the regulatory front goes, the prior SEC chief, Gary Gensler, was proposing a stopping something called payment for order flow. I'm not going to get into it, but basically it's what allows Robinhood and a lot of these brokerages to give you commission-free trades, right? And as an institution, you can't get those free trades. You have to pay a commission because you are seen as an informed trader. But that being said, he was trying to, go for traders' rights. That is Gary Gensler, and proposed this kind of misinformed regulation on payment for order flow. The new chief has come in, and that'll probably be gone. He's more institutionally well versed, and he's also more institutionally friendly. Not to say he's not retail friendly, but I think what he's trying to do is grease the wheels as opposed to trying to make a name for himself a little bit. Not many people in the crypto or option space liked Gary Gensler very much. So, so I think actually, other than the higher order kind of government stuff, the new SEC chair will be a positive, at least from stopping the negatives. Options are very available overall. But like you said, Alex, you need to learn, because otherwise you're going to find yourself in positions that you don't want to be in, and hurting your nest egg. Even if you win a little bit in the beginning,
Yeah.
you'll always give it up. You don't want to put in, when we talk about diversifying your portfolio, oh, you put 10% of your portfolio in these 10 stocks, and that's how you do it. If you put 10% in a long option, then it's gonna hurt. Like, if that doesn't work out, it's gonna hurt bad.
Yeah,
Um,
absolutely. So,
yeah.
and that's also the one thing that just kind of popped in my mind too, is that the interest in at least investing in options, where it changes from the traditional securities market, is that you have the ability to kind of bet more on just a strict data and market side of things than kind of what the company's actually doing.
Mhm.
If you're saying, okay, well, here's this, it's like, well, I think the price point could be X and Y because of this. You don't necessarily have to worry so much about, okay, well, is GE going to start making their fan blades for jet engines out of cardboard? Okay, well, if they do, well, that's something they're going to have to figure out. But I can take this from much more, again, just data and what the markets are doing than what the companies are actually doing. Granted, it affects its underlying security price, is kind of what this is all based on. But you can kind of divorce yourself from kind of the operations of a particular company and look at just, again, raw numbers and how they kind of play in the market, which is something I find valuable. Do I understand it? No. Do I personally invest in options? Not much, because again, I am well enough aware that my expertise can drive returns for other areas of my portfolio. But
Right.
again, it's just an interesting kind of viewpoint to take on it.
Yeah,
Um,
I'll give you
yeah.
actually an example. I talked before about how options are in essence an insurance product,
Mhm.
and and this is kind of a sad thing that happened, but in California, there's been, people lost their home insurance, like a year ago. The home insurance companies were saying this is going to be too expensive. Our actuaries are saying that, unless we raise prices astronomically, this is going to be a losing proposition for us. So they took away a lot of home insurance. And, when you can see, a data point like that, where a lot of people had to lose their home insurance because it was way too expensive, or, they just got it taken away, you could kind of infer that there's an expectation out there of these market makers, the companies themselves, that there might be something bad coming. And and now we know that there's, a ton of LA fires, and and how they're spreading, and the drought that they have over in California. And it's very sad, but it's kind of, every single option has that premium. When you see a hurricane coming, the premium on your home insurance is going to be a lot larger if you're buying it today than it is, if you're buying it if there was no hurricane coming. So I think, like, when you see things like that, and you can look at the, market, you could say, all right, I may not know every single thing that's happening with Intel or something, but I can look at these options and see that somebody's expecting something bad or good, or something like that. These institutions are expecting something that maybe I'm overlooking or don't have access to that information. And now you at least have the outcome of the information that they have. So that's kind of, when I look at option positioning, that is the important thing for long-term investors, people who are trying to make, their unsexy 10 to 15% per year, that's risk adjusted. That's the kind of thing that they should be looking at. So,
No, absolutely. And, come from someone I'm sitting in what is now nice, sunny, and cool Florida. Where I live in the Tampa St. Pete area, we had two hurricanes rip through here within
yeah.
15 days of each other. That was really fun to go through. But again, you can see that again, looking for the data side of, where things are going. And again, to the incredibly unsexy profession of actuaries, if you want to really kind of find some stuff, like, look at what the actuaries are doing. Those are the people that kind of are the canary in the coal mine of a lot of this stuff, that can be like,
Mm-hmm.
all right, well, we are sorting through 40 years of data science on this, and kind of here's what our specific market does. And then you can kind of, again, make that inference farther out as to, the ancillary industries that might be affected by it. And then again, start buying or selling options based on industries as a whole, not necessarily companies individually. You can kind
Yeah.
of spread that that expectation to markets a little bit more broadly with an option, at least in my opinion, than you would otherwise be able to if you're just doing a straight equities play or just a singular kind of options play on one company. Again, the cost price to do that being a little bit more available. So yeah, it's unfortunate that that's how, we more often look towards the bad with that kind of stuff than the good. It's like, hey, like, we're going to get a cure for cancer, right? And that's typically not the data point that we're going to get. It's, hey, like, we're going to have these Santa Ana hurricane force winds coming when we have a historic drought, and it takes literally one spark to create a hellscape in Southern California. Or, hey, global warming, whatever your opinion on it, might start spinning off hurricanes that slam across the state of Florida repeatedly.
Yeah.
I wish they would stop, but it's, I guess, the price of paradise. So
It's
again,
the price of paradise. A very humid paradise you have.
it's a very, very fun premium to pay to live in this state. But again, nowhere's perfect. It's like, do you want to live in Nebraska or do you want to live on the coast? You trade one thing for another. So I'll take what we have. Although we did, snow in Florida was definitely an odd thing that happened this year. So who knows? But kind of getting back to it, one thing that at least I find interesting from, going back to kind of the regulatory question that we were asking on, and it's definitely something that's going to play into the options space, is, you mentioned crypto. And one thing that I find interesting with that is, we keep kind of toying around with the, SEC and FINRA and all these regulatory agencies potentially starting to treat this as a security and, having stuff fall under securities law, which again would then open it up to a much more data-driven market of how options could be sold on these things. So there are markets out there where you can, in different cryptos that inherently built into their white paper, the ability to do contracts and options with them. But bringing it onto a scale like the U.S. securities markets, do you think that the push is for a securities designation to be done on crypto? And then how do you think that would inherently affect the options markets with being able to trade these on a much more kind of centralized marketplace like the New York Stock Exchange or a commodities exchange?
Yeah, well, currently there are options on, I guess you could say, derivative products or related crypto products. IBIT is an ETF that has options on it that tries to track the Bitcoin price. There's also a Bitcoin index from CBOE. I kind of tend to stay away from crypto myself, but right now the options market on all cryptos, I guess, that have them. I guess right now it's just Ethereum and Bitcoin, but the options market are pretty robust and very inefficient. There's a lot of my quanti kind of friends that have moved over to crypto because, equities are too hard. But that being said, if crypto does turn out to be a security, there will be, no doubt, there will be a lot of option pairings and stuff like that. You're going to have like Bitcoin to USD pricing, dollar pricing, but then you're going to have Bitcoin to Japanese yen and Bitcoin to Swiss franc. And so there are currently options on those pairings, not in the Bitcoin ones, but on like, USD to JPY, there's options on those currency pairings, and they are very liquid. They're very liquid. There's a lot of carry trades out there, which is borrowing from one currency and to buy in another. So you're going to see that a lot in Bitcoin, and Bitcoin's probably going to be a central repository of data on how the world currencies are doing. And we already kind of see that a little bit. It's a little volatile right now. But I think that, if Bitcoin becomes a security and options are traded on it, you're going to get a lot more efficient market because there's going to be a lot more players coming in to trade those options, and you're going to get a lot more, like I said, the math has gotten better, and that's why options exploded in volume. That math still applies to Bitcoin, so you're going to get that benefit. And I think that so when it comes to crypto, especially the big cryptos, I'm not talking about like the Trump coin or the to a coin or whatever. Those big kind of cryptocurrency, I guess, coins or however
Yeah,
you want to
your
call it.
blue chip cryptos,
Yeah.
your bastions of value in the market. Yeah.
Yeah. And I think that options will give you a lot more insight into what's going to actually happen in crypto. Right now, it seems like there's a lot of, at least in America, there's a lot of speculative, I'm going to buy it and sell it and, laser eyes. And, it's more like a community of, it's like a community of people trading it as opposed to anybody looking at the fundamentals of what it's all about.
Yeah, and I
So,
think those fundamentals are definitely going to be reinforced. And again, I mean, operating in the alternative space, especially in the tax shelter space that I do, I don't necessarily have, I'm not the one saying, sitting out there saying, hey, we need more government intervention. But the propensity to have something a little bit better regulated, I think, would create better markets for people and increase the safety and kind of, again, help to really filter out that noise with the fact that basically, I mean, call it what it is. I mean, anyone can create a security right now.
yeah.
You're out there selling something. It's, hey, I'm going to write a white paper. And to your point about the Hawk Tua stuff, and also different other coins have been put out there. It's really interesting to look at some of the case studies and the investigations done into these things of just like how bad it can be and how these people just get not to use the terms are so awful and kitsch, but the rug pulled out from underneath you. Again, no intention. It's just the best analogy I can come up with of just like how this stuff works and to create, new markets that people can find value in. Like you said, your peers and friends going over there because there's so many efficiencies. It could be nice to have something new that has some inherent big inefficiencies that can be fixed with it. So it'd definitely be interesting to see where it goes. Do you, kind of have any feeling on whether or not that kind of regulation is coming from the SEC? Are they,
Oh yeah, I think,
chief is...
yeah, I think, again, Gensler, I'm going to pick on him a little bit, but he was more of the ilk of, if I see you doing something wrong, I'm going to, attack or, I'm going to come after you. But it was never quite defined what right is or what wrong was. And I think, the new SEC chair has kind of expressed that, or chief or, whatever, he's kind of expressed the desire to define crypto and define how it is going to be traded. So, or how it's going to be treated as from the SEC and FINRA standpoint. So I think that will absolutely increase liquidity a little bit in crypto. America doesn't exactly have very many, with FTC and, a bunch of, crypto exchanges going down. America doesn't exactly have like many choices in getting like an actual Bitcoin in their digital wallet. And I think that when crypto is defined by the SEC, there will be a lot more industry, institutions that will enter that space and try to take advantage of that liquidity, because obviously there's a huge demand for crypto, and they're going to want to be the marketplace for it.
Yeah, and if we can hopefully help to sift some of the massive amounts of grift that's coming out of that whole market segment,
Yeah.
I think, again, it'll just be better for the investor in general and better for the market. If you want people to adopt this safely, then, get rid of the bad actors or make it significantly harder to give the fine penalties for what they're doing.
Yeah.
So again, not to segue too far into the crypto space, so that's, again, it's a whole other thing. But I just find it, interesting from the, options perspective is that we have such a high amount of trading and volume on something that doesn't really have a big repository of options information. There's really the smaller, more individual places, but you don't have kind of a defined and regulated market, which, say what you want to about regulations, they do typically at the end of the day work towards the safety of the market and the investor in general. Can they be hard to navigate? Sure.
They try.
Yeah, they try, and we give them a little pat on the back. Nice try.
Yeah.
But to kind of come back into kind of what you do and why you do it. Again, data science being at the core of what you're doing and looking at, institutional deal flow and volume and where people are looking and taking into account all these other external factors. What exactly did you build out? We kind of alluded to it with Volland. Is it Volland or Volland?
Volland, like
Volland.
Holland, but with a V. Actually,
um,
when we named it, and it's www.vol.land. When we named it, my family was looking to going to Disney, and
mhm.
it's Tomorrowland, and Fantasyland, and then this is Volatility Land. There you go, Volland. So
There you go. So again, kind of looking at that, but at its core, what is the product that it's putting out there? Again, we've kind of touched on it, but I think it's
yeah,
really interesting. It goes from our pre-call to do this interview of what you've kind of built for this.
yeah.
Yeah.
So essentially, what we do, I mean, we have like a lot of very smart network engineers behind the scenes in the back end, and we hook into the options pricing regulatory authority feed. So this regulatory authority takes in every single option trade that's on the market, and they give you a bunch of details about these option trades. We use those details to make a determination: is the dealer buying or selling those options? Mathematically, of course, that's kind of how we work here. And then we aggregate the net positioning of dealers, those middlemen. And once we aggregate that position, then we do calculate a bunch of hedging, those Greeks that you were saying that there was a lot of nomenclature, bespoke options terminology. We call them Greeks, but half the words aren't even Greek, like Vanna. There's no Greek alphabet. But anyway, regardless, I'm going
Yeah.
off track. So we look at the terms of hedging that dealers are going to have to do based on this book, and we display it for everybody. This is what we have, and it's very we've measured it against exchange data. It's very it's pretty accurate, and we and this is a subscription. We have quite a few subscribers who you can use it to day trade, you could use it to swing trade, you could use it to invest, and kind of see where you should be buying or selling your stock. Even you don't even have to know options in order to take advantage of this platform. So I think that what we did is now we have all this history too. We can use AI, determine certain trends. That's what we do, and that creates a very strong edge in investing too. And we, that's part of our ethos is looking and helping, try to make these informed decisions.
No, absolutely. And so how far back, I mean, when did you kind of get the start? So like, where was kind of like day one on when you start doing like the real trend analysis of everything? Because again, you have tons of data, but once you start looking at it, you start kind of making your own inferences. So like, when did you really kind of start to reach a critical mass of being able to really scrape and make, those really informed viewpoints available?
Yeah. So SPX, the index, has the most notional traded on it every day by far. There are more options traded in SPY, but because SPY is 10% of SPX in value, there's more notional in SPX than any other underlying. So we bought some history on that one. We have that back to 2017. Our start was in 2022. So we have all of that data back, for individual stocks and stuff all the way back to 2022. We do have a lot of metrics on there, if you're calculating how, we talked about how dealers buy at the ask and sell at the bid. We have metrics that show how liquid the market is by determining how wide that spread is. We have all kinds of like little metrics that we can make because of the way we do this. We see like the execution prices, the exchanges that the trades are on, stuff like that. So I guess, we have a lot of data, from now back to 2022, SPX, which we use mainly because of how much notional it is, back to 2017. We also have a white paper that kind of describes what we see in that data too. So.
Okay, great. Yeah, I think that's definitely a key point to help is like kind of having the people that are providing data give some analysis on it too,
Mhm.
because it's not all of us are data scientists.
Right,
I
right.
know for certainly I am not. I know enough to be dangerous, but that's about all I am is dangerous. um, so, from here, to kind of bring this in for a landing, where do you kind of see, um, things that are coming up for the alternative investors? What do you see as kind of like the highlights of, the market that you're in with options, and more of a broader context for just, people outside the general, securities, buy, sell, hold, trade, kind of markets?
So I think with options, we are seeing a lot more institutional acceptance of options. Um, and overall, I mean, part of what we are doing at Ad Deum Funds is almost, I don't want to say recreating, but we're mimicking things like annuities, where, those variable annuities that, give you a defined, gain on the SPX and protect you from loss, and usually at a fee, sometimes not, but usually at a fee. And we can recreate that at way cheaper. I think that options will create products for investors, like, for longer term investors. They'll create products that are a lot stronger than, and risk adjusted than what we have now. And that's what we're trying to do at Ad Deum Funds, or the RAA. So if you're not a person who likes to day trade, or you don't care about all this option stuff and you don't want to get educated, that's why we opened up our RAA, our Registered Investment Advisory Firm, so that we can do it for you, and that's kind of what we, that's kind of, our business format. And I think that there will be more products offered out there. But you do want somebody who is not in the, you want somebody who's not really in that fee collecting, kind of area, that it's a little bit ahead of the curve on these institutional products.
No, absolutely. And, to have kind of that nice, marriage of the data science part to the RIA part, I think is, not something that I don't think I've really ever seen in anyone that I've, professionally dealt with, or at least interviewed on here as well. So I think that's, definitely kind of an interesting take on it, because most of the time you gravitate towards one or the other. People either farm out their data science to someone else, sometimes they have it in house, but to have kind of the duality of the platforms is pretty compelling. If people want to learn more about what you have going on either side of the equation, how can they reach out to you?
So we have our website is www.addeumfunds.com, ADDEUMFUNDS.com. That's the RIA. And, you can contact us. You can email us. info@addeumfunds.com is our primary contact email. If you're interested in Volland, if you're a trader and you want to determine for yourself how you're going to buy or sell your underlying stocks, www.vol.land is the website. And you'll see on there our white paper. You'll see a link to our Discord. We have a very great community in a Discord that is always willing to help. And that, so we don't leave you in the cold. We're data scientists, but we're not that introverted. All right, maybe some of us are, but but we have a great community, and a lot of people have been finding this as a great source of edge. So
Nice.
yeah, come
So a
and
great
join us.
community of people you don't want to play poker with, right?
Oh, that's true. Very true.
Yeah, I had a buddy in college who was a math major, and I was like, anytime he'd sit down at a game and be like, yeah, I'm gone. See ya. There's none of this for me. Well, again, I do really appreciate you being on with us today. I think it was a good high level of, kind of what exactly the options market is. Maybe not necessarily what an option is. We certainly covered on that, but I think so few people understand kind of what the options market is. You might understand, hey, I can, buy and selling calls and puts, right? That's generally easy enough. And again, what an option is, again, easy enough. But people don't realize that there is such a huge market for this, not just, individuals doing this. There's a huge institutional. What was the amount of option contract volume that you mentioned?
About 55 million options traded per day. And then some of these stocks too, there's more notional traded in options than there are in equities. So
yeah, which is just
insane.
mind-boggling to me. So again, there's it's not just you going at it alone. There is a market, there is data, there are people that can, provide investments that are, based on that data or, data for you to make the decisions yourself. So I think that's really kind of what I want people to take away from this is that, just understanding how much deeper options are and the fact that there is an ability to sift through the noise and find what you need to make those informed decisions. So again, Jason, really do appreciate you being on with us today, taking your time to help to bring this kind of to the forefront of what people are looking at, because it's certainly getting a lot more traction with our clients. We've seen a pretty precipitous pickup in people wanting to invest or deploying different option strategies with their accounts that we do on the custodial side of what we do. So again, great information. Really appreciate you being on with us. If anyone wants to reach out, again, if you wouldn't mind plugging your contact information again.
Yeah, sure. So if you're interested in the RIA, email info at addeumfunds.com, ADDEUMFUNDS.com. If you're interested in, seeing this data for yourself and learning how to use it, go to www.vol.land, L-A-N-D, no.com. So,
all right. Fantastic.
Yeah, they put more extensions out there. It's great. But www.vol.land for seeing that data yourself. So
fantastic. Well, again, Jason, thanks for being on with us today. As always, my name is Alex. This has been another edition of the Alternative Investing Advantage podcast. Thanks for joining with us, and we'll see you on the next one.
Thank you for tuning in to the Alternative Investing Advantage podcast. Tune in next week for more investing tips and strategies.
Want to hear more episodes of the Alternative Investing Advantage? Search podcast at advantaira.com and subscribe.